So, today we're diving into GAAP, a framework that, standardizes accounting practices in the US. It's like the guiding blueprint that ensures financial reporting remains consistent and transparent.
Right, yeah. And GAP's foundation comes from the FASB, making it mandatory for many companies, especially public ones, correct?
Exactly. GAAP is set out to make sure that financial statements are reliable. It's like you could compare a company's numbers over several years because the same methods are used every time.
Yeah. That consistency sounds essential. So, what's the core idea behind it?
Well, the number one rule in GAAP is actually the principle of consistency. Essentially, it means sticking to the same accounting methods from period to period, so it's easier to track changes over time.
Right, exactly. So, if a company wants to change its method, they need to clearly explain the reason behind it and, show that the new method is better in some way.
Yes, exactly. It's like, imagine you're following a recipe every time to, say, bake a cake. If you suddenly switched the ingredients without telling anyone, the taste would be off, and you couldn't tell if the change was for better or worse.
That's a neat analogy. I see. But don't you think that sometimes a business environment changes so much that sticking to one method might become a hindrance?
That's a fair critique. However, the thing is, the consistency rule, while perhaps seeming rigid, is really there to build trust. If you change your methods without clear disclosure, people can get confused about your actual performance.
Yeah, I get that. It's like balancing on a tightrope, right? Consistency builds comparability, but too much rigidity might cause you to miss out on reflecting current trends.
True, there's definitely a fine line there. But overall, with GAAP being required for publicly traded companies, the benefits of consistent financial information usually outweigh the potential downsides.
Absolutely. And it was interesting how GAP was compared to a kind of certification, almost like earning a 4-year degree in accountancy. That analogy really underlines the importance of GAAP.
Yes, indeed. It's like having GAAP is a stamp of credibility and rigor, showing that a company or its accountants have met high standards in financial reporting.
Yeah, that's spot on. So, overall, we can say that GAAP not only ensures transparency in financial records, but also holds companies accountable by making sure changes are always clearly documented.
Exactly. That clear documentation and adherence to the principle of consistency really enable investors, regulators, and other stakeholders to accurately compare performance over time.
That makes a lot of sense. It's pretty fascinating how such structured rules can create a stable environment for financial analysis, don't you think?
Absolutely. It's like the backbone of financial integrity. Without these principles in place, our financial reports would be all over the place.
Right, exactly. Well, that was a thorough look at how GAPI and, in particular, the principle of consistency plays such a critical role in accounting.
Totally. It's been a great discussion exploring how these rules not only ensure reliability, but also drive the trust in financial reporting that every investor relies on.
Yep, awesome discussion.